have had this significant performance. The market has been rising for the last 5 years at about 20% per annum, and over the last year it's over 30% per annum, and even so far for the first 6 months of this year by about 12.5%, which is significantly higher than the returns that are taking place in different asset classes, or in fact in the growth of the economy. So some investors are saying, well, is the stock market too high? And it's obviously very difficult to forecast what's going to happen in the stock market going ahead. But most people who are saying the market is too high are really looking at one variable only. And that is that the multiples, what they call the price earnings ratios of the market, the Johannesburg Stock Exchange, are now at highs that are significantly higher than the long-term averages. And we can obviously unpack that one and explore that. But there's a couple of things we need to look at first. The first is that the real run in the JSE, and it came from a very low base. 2008, 2009 was supposed to be the financial collapse of all time, worse than anything before. Up until 1929 was the only one comparable. So we're coming from a very low base. So when we're talking about very good performance of the market over the last 5 years, it actually took until last year for the stock market to go back to where it was before the 2008 collapse. So the real return in the stock market hasn't been all that high. And in fact, it would need to establish record highs for some time to come to give the sort of real returns that you would expect from a stock market over time. But the other thing, let's unpack the high price earnings ratios in the market. If you look at the top 40 shares on the JSE, the top 10 shares have a price earnings ratio of 25 times earnings. And typically, some of your historical data says that once you go about 14, 15 times price earnings, the market's too high. But if you look at the bottom 10 or 15 shares in the top 40 index, they've got a price earnings ratio of 13 times earnings. So what's really happening is it's just the top companies, the top 10 companies, and in fact, to be honest, the top 5 companies that are really high. These are the ones with high valuations. Now, what sort of companies are those? Those companies are not South African companies. We're now talking about South African breweries, Richemont, British American Tobacco, and others which are global companies. So these companies have got nothing to do with what's happening in South Africa. They are earning all their money and being priced internationally. The fact that they are listed on the Johannesburg Stock Exchange is as a secondary listing. So what you're really buying when you're buying those very high PE ratio companies is you're buying companies that have the bulk of their earnings taking place internationally, and people are putting a premium on that. Not only local investors, because they're saying we're not buying South Africa with its low growth rate, we're buying a global reach, but we're also finding that international investors, when they come and buy South African shares, just buy those top 10 companies or so. So what's really happening in South Africa, it's become a two-tier market. The really big companies attract all the institutional money and increasingly the retail money, because that's where the action is, and they got a very high valuation. The rest of the market has quite low valuations. And so will the market return to the valuations that we've seen in the past, or are we facing a secular change where the stock market in South Africa is going to become a two-tier market where you'll have certain quality companies, which are so-called global companies, and they will trade at much higher yields or earnings or price earnings ratios to the rest of the market? Now, this is not unique. In other emerging markets around the world, the top echelon of companies trade at significantly higher multiples to the rest of the market. So that's the first thing. The second thing is we're seeing a global move towards equitization. International investors worldwide are saying, well, we have a crisis in that people are getting older and they're going to live in retirement for considerable periods of time. In America, they now value, if you go into retirement, they assume as an actuarial fact that you'll live at least 30 years in retirement. Now, if you're going to live 30 years in retirement, you can't turn your money into cash and hope that your cash is going to last for 30 years. You have to put the bulk of your portfolio into shares, into equities. And so we're having a process of equitization taking place worldwide. And international investors are saying, well, we don't just want to buy American equities, we want to buy top companies around the world. And those top companies in South Africa are the ones that they're purchasing. And as I say, they're not necessarily South African companies. They might be based in South Africa, companies like MTN and Naspers and Bidvest. But the fact is that they earn all basically they earn most of their money abroad. So the market is starting to re-rate those global companies. And we've got a two-tier market in South Africa. And if that's the case, then is the JSE too high? Well, it may well not be.